Maybe you heard me say many times that I believe that REITs are actually one of the best opportunities in 2023, for investors to take advantage of. And this is mainly because of the higher interest rates that we have. It makes REITs less attractive because investors can go and get a 5% yield on their money, 5% return buying short-term treasuries and other kind of instruments. Why would they take the risk and buy REITs? And a lot of the REITs have been trading at pre-COVID levels, some of them trading below pre-COVID levels. And I believe this creates an amazing opportunity because the 5% interest rates that we have are not going to be here forever. Even the Fed themselves, they said that the long-term neutral rate is around 2% to 2.75%. So it's 50% lower than it is right now. And whenever we do get back to something like 1 to 2% interest rates, which could be next year, could be the year after, it could be 3 years from now, we don't know when, but if that ever happens, then investors are going to chase yield again. They want higher and higher yields, and this is where they can go and look for a lot of those REITs like Realty Income. And the best part is that a lot of those REITs are offering higher dividends, so you actually get paid while you wait. So in this video, I'm gonna try to analyze Realty Income. You could see the chart is horrible on this one. It's sitting pretty much at the same level where it was crashing in March 2020, even more like around 2019 or 2018 levels. So this is pretty crazy for a very high quality REIT like Realty Income. I mean, such opportunities, they don't come every year with this REIT. It's a very well-known REIT. I'm sure most of you actually know this company. They are very well known for actually paying monthly dividends. So if you buy Realty Income, you actually collect a monthly dividend, which is, a lot of dividend investors actually like. I'm not a dividend investor, but a lot of the dividend investors really like Realty Income. They have been growing the dividend around 4%, 4.5% actually every single year since 1994. So they go, way back. They have an international presence, not only in the United States, but also in Europe and especially in the UK. They own a lot of things in the UK, some of those Tesco properties and a lot of other things. They are pretty diversified. They claim that 91% of the rent is actually resilient in terms of a downturn, of any economic downturn. It's pretty resilient, and I believe the company is right, because if you look at the tenant profile of this REIT, it's pretty resilient in my opinion. They have tenants like Dollar General, Walgreens, 7-Eleven, Dollar Tree, Wynn Resorts. Maybe Wynn Resorts could be somewhat, but they own the property and Wynn is paying them rent. I don't think Wynn is going to zero. FedEx, LA Fitness, BJ's Wholesale Club, I talked about it many times, Walmart and CVS. I mean, such companies are pretty resilient. Maybe AMC Theaters is not so resilient, or Regal Cinemas, but it's only like, around 2.5% of total, in terms of their portfolio. So I believe the company is well positioned in terms of some kind of an economic downturn that we could potentially have. They have a lot of exposure to groceries, convenience stores, dollar stores, drug stores, health and fitness, automotive repair. I mean, such areas are pretty resilient, so I'm not worried about some kind of a dividend cut with Realty Income in terms of the tenants themselves. I'm going to take a look at their free cash flow later in the video. But if you look at the profile in terms of the lease expiration, most of the leases, around 46.5% of them, actually expire after 2032. So there's a lot of visibility in the portfolio. And if they have tenants like CVS and Walgreens, I mean, I just don't believe that CVS is going to decide to move to a different property, or something like, Wynn Resorts is going to decide to move to a different property. I don't think this is really going to happen, because they will most likely renew the leases and then maybe even get higher rents for them because of the recent spike in inflation that we had. So I'm not worried about tenants of Realty Income not paying up. Maybe something like the theaters, they're not going to pay up, but it's only like 2.5%. So I believe it's pretty resilient company, pretty amazing, and I really like what I'm seeing so far. Now, if you look at the dividend yield of Realty Income, it's around 5.17%. So you get around a 5% dividend yield if you buy, the company today, and you get them paid pretty much every single month. Now, if you look at the history of the company, the dividend yield is more of the higher end of the range. Most of the time, the company has been yielding around 4.5%. Occasionally, it was yielding around something like 3.5%. This is when when we had 0 or 1% interest rates. But now it's yielding around 5%. The highest the company has yielded is around 6.5%, and now it's around 5%. And this is outside the 2008 to 2009 financial crisis. So you could see, looking at the dividend yield, it's higher than the historical average. So that would tell us that, Realty income could potentially be undervalued. Now, this is the biggest problem I have with this company, with most REITs, and why. I mean, I do buy REITs, but I'm very selective in terms of the REITs that I buy, and I really worry about the shares outstanding going up so much. A lot of those REITs, they issue shares, they take the proceeds, and they go and acquire more properties to create more free cash flow, and then they just keep doing it again and again and again, which is why it's very important to look at per share metrics in terms of those REITs. You cannot look at the net income growth. You have to look at net income per share. You can't look at the free cash flow growth. You have to look at free cash flow per share, because they paint a very different picture, and this is largely due to the share issuance from those REITs. And if you look at Realty income, they issued a lot of shares in 2022 because they did a lot of acquisitions. And this is one of the reasons why the stock has suffered, I believe, in August and September, because the dilution was pretty massive. And this is one of the risks and one of the problems I have with this company and with other REITs in general. But if we actually look at the FFO per share to try to see if they actually created any value from those kind of share issuance, and the company actually did create some value. If you look in 2017, the FFO per share was $2.82. Now in 2023 is $4.13. So I don't believe they created enough value to offset the dilution, but they did create some value from it. Now, if I was looking at this graph and I was seeing the FFO per share down while the shares outstanding was up, I would not even touch the company. I would just finish the video here and move on. But I believe there's still an opportunity, because Realty income has been able to create value after they actually issued shares, which is not really such a huge problem in this case. Because if I own a company and they issue shares, but they create more value for me, with the shares that they did, I would be a pretty, satisfied shareholders. Not all share dilutions are actually bad. But this is one of the reasons why I prefer apartment REITs, because if you look at this company that I talked about in my video, and I also used to own this company, and this is Mid-America Apartment Communities, they don't issue shares to do acquisitions like Realty income does. They take on some loans to do it. They use the free cash flows they generate and they reinvest it, and they also grow the dividends and stuff. So it's a pretty amazing company. But if you look at the shares outstanding since 2017, I mean, they're barely up like 2 or 3%. So it's nothing. They don't implement this business model. And this is why I believe if you look at the chart of both of those kind of companies, you could see which one was performing much better. So this is one of the reasons why I like the apartment REITs, because a lot of the apartment REITs, they actually don't issue shares to do acquisitions, and this is just a better preference for me. Now, Realty income was able to create value to shareholders from that, so it's not such a big deal. But for me personally, I like the shares outstanding to be flat with something like Mid-America Apartment Communities. Now, if we look at the free cash flow profile to try to determine if the dividend is actually safe or not, we could look at the spread between the cash from operations and the common dividend paid. Now in 2020, there's a pretty good gap, 2021, and even in 2022, you could see they created much more cash from operation growth because of the acquisitions. The dividend actually got increased, but there's still a pretty wide margin between the common dividend paid and cash from operations. They collected around 2.5 billion cash from operations. Common dividend paid is 1.8 billion. They have almost no capex. I mean, very small. I didn't even include it in the free cash flow. So I believe they have a pretty good spread, around $700 million between the cash from operations and the common dividend paid, which would lead me to believe that Realty income's dividend is actually safe, and they will likely continue to grow the dividend further in the future. But if we look at the debt that Realty income actually has, they actually don't really have a lot of debt because they issue shares for acquisitions and stuff, but they do have some note payables. This is their largest amount of debt. It's around 15.2 billion. They have some of it due in 2024, 2025, 2026. I believe the company can handle this over the next few years, and if they have to issue shares and pay them off, they eventually gonna do it, because this is what this company does, but most of the debt is actually due after 2027. Around 9.3 billion is due after 2027, which is why I believe that the dividend is actually safe between the spread of the cash from operation and common dividend, and the free cash flow is pretty resilient for this company. So the dividend is safe. I believe the company is going to continue to raise the dividend in the future. Now, if we look at how much we're actually paying for all realty income and for REITs, I like to use the price to FFO per share. I don't use net income. I just use two metrics. The first one is the dividend yield. If the dividend yield is higher than the historical average, that would tell me that there's some pessimism that the company could potentially be undervalued. But the second thing I use with those companies is the price to FFO per share, and this is something I use with most of the REITs. Now, price to FFO per share is trading around 14 times those FFO per share. The mean for the company is 17.5, so it's trading well below the mean. Now, the lowest, you can see it's trading at pretty low levels on a historical basis. So you could see that you're getting a pretty good deal on a historical basis if you're actually buying, all realty income at such prices. You're buying it at March 2020, kind of lows. But the lowest the company has ever traded at was around 8 times FFO per share. And this was more around the 2008, 2009 financial crisis. Now, I'm not sure if we're going there or not. I mean, the lowest we could go is maybe 12 times FFO per share. This is like at the bottom of March 2020, and I would doubt if we ever get there. But I mean, you could see that you're getting a pretty good deal if you're actually buying all realty income at such prices. Now, the biggest problem I had with this company is trying to do some kind of evaluation model, because it's almost impossible to tell, what's the FFO per share is going to be 5 years out, because you could put any kind of gross numbers, but the company might do something else. Maybe they issue a lot of shares next year. No one expected them to issue and do all those acquisitions that they did in 2022. So if you had done evaluation model in 2021, it would have been distorted, because you can't predict what the management is going to do. You can't predict how many shares are they going to issue. So in this case, I'm trusting over 40 analysts that are actually putting up those numbers on tickers. They have, they tell you how many analysts are putting them up. There's over 40 analysts for, 2024, 2025. Then there's a few more for 2026 and, 2027. So I'm trusting those analysts with this very simple calculation, and you don't have to trust them. But I personally believe, looking at those numbers, I believe it could be somewhat accurate. It could be a little bit higher if they do more acquisitions. It could be a little bit lower, but I believe this is a very fair number if you look at the history of how much O was able to actually grow their FFO per share. So if we use the 485, FFO per share for the company, and we time it by 17.5 price to FFO per share, because this was the historical average. So we're betting on O getting back to the historical average in the next 5 years, whenever the Fed eventually, slows down interest rates. I don't believe they're going to be at 5% in 2027. If I had to guess, I would say 1 to 2%. But what do I know? But I believe, it's going to eventually turn to the mean of 17.5 price to FFO per share. So if that actually happens, all realty income would be trading around $84.87 per share. So pretty close to $85 per share. Now, if you divide that by the current share price of somewhere around $59 per share, you're getting around 43% on the upside over the next 5 years, but this is not including the dividend. So if you take the 43% and we have 5% every year for the next 5 years, so that's 43, and you add in 25 for the dividend, you get around 68 to 70% on the upside over the next 5 years with all realty income, not including if they do some kind of a crazy acquisitions that bumps up the FFO much higher. And this does not include the dividend growth, which the company does grow the dividend, I believe 3.5% or 4% every single year. So around, somewhere around 68% on the upside over the next 5 years. I don't believe this is a bad return at all for all realty income. Now, as I said, and you could watch my video, I personally like apartment REITs. Whenever I bought REITs in the past, I mostly bought apartment REITs. So I really like Mid-America apartment communities. You could watch the video, but I believe all realty income is really not bad at such prices. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.